Interest rates feel simple on the surface. A number goes up, a number goes down. News anchors explain it in seconds, headlines reduce it to a single decision, and most people walk away believing one thing: central banks decide everything. But interest rates are not a switch, they are not a command, and they are not fully controlled by any single institution. They are the outcome of a system shaped by power, trust, fear, expectations, and debt. To understand who really controls interest rates, we have to step away from the announcements and look at the structure underneath. For decades, central banks have been presented as the masters of money: independent, technocratic, above politics. They meet behind closed doors, release carefully worded statements, and adjust policy rates in quarter-point increments that ripple through the global economy. At the shortest time horizon, this power is real. Overnight lending rates, interbank funding, short-term liquidity. These respond almost instantly to central bank decisions. If a central bank raises its policy rate, borrowing overnight becomes more expensive. If it lowers rates, liquidity becomes cheaper. But here's the first misconception: short-term control is not the same as long-term control, and long-term interest rates are where real power lives. When a government borrows money for 10, 20, or 30 years, it does not borrow from the central bank. It borrows from investors, pension funds, insurance companies, sovereign wealth funds, foreign governments, private capital. These investors do not care about today's policy rate. They care about the future. They ask different questions. What will inflation look like 5 years from now? Will this currency retain its purchasing power? Is the political system stable enough to honor its debt? Will I be repaid in money worth less than what I lent? The answers to those questions determine bond yields. Not speeches, not press conferences, not promises. This is why long-term interest rates often move before central banks act. Markets do not wait for permission. This dynamic becomes clearer during periods of inflation. When inflation rises, investors demand compensation. They want higher yields to offset future loss of purchasing power. A central bank can say inflation is temporary. It can say expectations are anchored. It can say policy remains accommodative. But if markets do not believe it, yields rise anyway. This is not rebellion, it is arithmetic. Between the central bank and the bond market sits another critical layer: commercial banks. Banks are often misunderstood as passive channels, simply passing on policy rates to consumers. In reality, banks price risk. They borrow short-term and lend long-term. They evaluate creditworthiness. They account for regulations, capital requirements, and liquidity constraints. A policy rate cut does not guarantee cheaper mortgages. A rate hike does not automatically choke off lending. Banks decide how much of central bank policy reaches households and businesses. This is why monetary policy often feels unpredictable on the ground. The signal weakens as it travels through the system. But there is a deeper force that limits everyone's control: inflation. Inflation is not just rising prices, it is a loss of trust in money. When inflation accelerates, it signals that the balance between money and real output has broken down. And once trust erodes, interest rates follow. This is why history shows a pattern. Central banks can suppress interest rates temporarily. They can buy bonds. They can flood the system with liquidity. They can promise stability. But they cannot force people to believe. And belief is what keeps yields low. The 1970s provide a clear example. Governments attempted to stimulate growth while tolerating rising inflation. Interest rates were held artificially low relative to inflation. The result was predictable. Bond investors demanded higher yields, currencies weakened, inflation accelerated further. Eventually, central banks were forced to tighten aggressively, not because they wanted to, but because the system demanded it. Control was lost first, then violently reclaimed. This pattern repeats in subtler forms. In highly indebted economies, interest rates become politically sensitive. Higher rates mean higher debt servicing costs, higher deficits, budget stress, political backlash. This creates pressure on central banks to maintain low rates. But markets see this pressure, and when investors believe rates are being kept low for political reasons rather than economic stability, confidence erodes. The demand for risk premiums rises. Again, not immediately, but eventually. This is where the illusion of control becomes most dangerous. When central banks appear powerful, governments borrow more. When governments borrow more, the system becomes fragile. When the system becomes fragile, markets become skeptical. And skepticism shows up in yields. Interest rates are not a moral judgment. They are a pricing mechanism. They reflect perceived risk. Quantitative easing complicated this dynamic. By purchasing government bonds at scale, central banks blurred the line between monetary policy and debt financing. In the short term, yields fell. Markets stabilized. Crises were postponed. But the long-term question remained unanswered. Can rates stay low without confidence? QE replaced private buyers with public ones. It did not eliminate risk, it redistributed it, from markets to balance sheets, from investors to institutions, from the future to the present. This is why interest rate control always has a shelf life. As long as inflation remains contained and credibility holds, central banks appear omnipotent. When inflation rises or trust breaks, markets reassert control, and they do so faster than institutions can respond. Another misconception is that interest rates are purely domestic. They are not. Capital is global. Money flows to where it feels safest. If one country suppresses rates while another offers stability, capital moves. Currencies adjust. Imported inflation rises. Domestic rates feel pressure. This is why no central bank operates in isolation. Interest rate control is relative, not absolute. So who really controls interest rates? Not central banks alone, not markets alone, not governments alone. Control is conditional. It exists at the intersection of credibility, inflation expectations, debt levels, political stability, global capital flows. When these align, central banks steer smoothly. When they diverge, control becomes fragile. Interest rates are best understood not as commands, but as signals. They signal trust or doubt, stability or risk, confidence or fear, and signals cannot be ordered into existence. They must be earned. This is why every attempt to permanently control interest rates has failed. Empires learned it, modern states relearn it, and financial systems quietly enforce it. You can delay adjustment, you can disguise it, you can redistribute its cost, but you cannot eliminate it. In the end, interest rates answer to something older than central banking: reality. They reflect the balance between promises made and value produced, between money created and goods available, between debt accumulated and income generated. When that balance holds, rates stay low. When it breaks, rates rise. No meeting can change that. So the next time a central bank announces a rate decision, remember, you are not watching the source of power. You are watching the response to it. The real decision was made earlier, quietly, in expectations, behavior, and belief. Interest rates are not controlled, they are revealed.